Basics of Investing. Chapter 15, Advanced Concepts. Section 1, Derivatives. A derivative is a financial contract whose value comes from something else, called the underlying. That underlying might be a stock, a barrel of oil, an interest rate, a currency, or even a market index. The key idea is that you usually are not buying the asset itself. You are buying or entering a contract tied to what happens to that asset. This makes derivatives very useful for transferring risk from one party to another. A farmer might want protection against falling crop prices, while another party is willing to take that price risk in exchange for potential profit. Because of that, derivatives are commonly used for hedging, speculation, and sometimes arbitrage when traders spot pricing differences. People use derivatives for very different reasons, even when the contract looks exactly the same. A hedger uses them defensively to reduce a risk they already have in the real world. For example, a wheat farmer may lock in a future selling price, or an airline may hedge fuel costs, so its expenses are more predictable. A speculator, by contrast, uses derivatives to express a view that prices will rise, fall, or become more volatile. An arbitrager looks for temporary mispricing between related markets and tries to capture a small profit with limited net risk. So the tool itself is neutral. What changes is the purpose of the person using it. The four major derivative types are forwards, futures, options, and swaps. Forwards are private agreements between two parties, and both sides are obligated to complete the deal later under custom terms. Futures are very similar in economic purpose, but they trade on exchanges in standardized contract sizes and dates. Options are different because the buyer gets a right, not an obligation, which creates an uneven payoff profile. Swaps are agreements to exchange cash flows over time, often based on interest rates or currencies. If you remember who is obligated, where the contract trades, and how the payoff works, you can usually tell these contract types apart. Forwards and futures both let parties lock in a price today for a transaction that happens later, but the structure around them is very different. A forward is negotiated over the counter, directly between two parties, so the terms can be customized to fit a specific need. That flexibility is useful, but it also means each side depends more heavily on the other side's ability to perform. A futures contract is standardized and traded on an exchange, which makes it easier to enter and exit. The exchange clearinghouse stands in the middle and reduces default risk by requiring margin and settling gains and losses daily. So forwards offer flexibility, while futures typically offer more market protection and liquidity. Options and swaps solve different kinds of problems. An option gives the buyer a choice, a call gives the right to buy at a strike price, and a put gives the right to sell at a strike price. The buyer pays a premium up front for that right, and the most the buyer can lose is usually that premium. The seller, however, may have significant obligations if the option is exercised. A swap works more like an exchange of payment streams over time, such as one party paying a fixed interest rate while receiving a floating rate. That can help a company turn uncertain interest costs into more predictable ones. Most derivative positions follow a similar life cycle even when the contracts themselves differ. First, the parties agree on the important terms, such as the underlying asset, size, strike or reference price, and expiration date. At entry, there is usually an initial cash commitment, such as margin for futures or a premium for options. After that, the position's value changes as the market moves, sometimes quickly. Before the contract ends, the position may be closed out with an offsetting trade, or it may continue to settlement. Depending on the contract, it can be settled in cash, exercised, or simply expire. Understanding this sequence helps investors focus not just on the market view, but also on how the position behaves over time. Counterparty risk is the risk that the other side of a contract cannot do what it promised to do. This is especially important in over-the-counter derivatives, where the buyer and seller rely directly on each other. If one side weakens financially, the value of the contract may not matter much if payment never arrives. Exchange-traded derivatives reduce this problem by using a clearinghouse that stands between both parties. The clearinghouse requires initial margin, maintenance margin, and daily mark-to-market settlement to recognize losses quickly. That process helps prevent large unpaid obligations from building up over time. It does not remove all risk. but it usually makes exchange-traded derivatives safer than comparable OTC arrangements. Three ideas explain much of the risk in derivatives: margin, leverage, and time decay. Margin is not a down payment in the usual sense. It is more like a performance bond that supports a much larger notional position. Because the contract controls a large exposure with a relatively small amount of cash, even small moves in the underlying can create very large percentage gains or losses on your posted capital. That is the effect of leverage. Options add another layer because time itself affects value, especially for long option positions. If the expected move does not happen soon enough, time decay can steadily reduce the option's value even if the underlying price barely changes. Consider a crude oil futures contract for 1,000 said and nows entered at $80 per barrel. The total notional value is $80,000, but the trader may only need to post about $6,000 in margin. If oil rises from 80 to 85, the gain is $5 per barrel, or $5,000 on the contract. If oil falls from 80 to 75, the loss is also $5,000. Notice how a move of just 25% in the oil price creates a profit or loss almost as large as the original margin deposit. That is why futures can be powerful tools, but also dangerous when position size is not controlled. One of the most important practical realities in futures is the margin call. If losses push the account equity below the maintenance margin level, the trader has to add cash or the position may be reduced or closed. That means a trade can fail from a cash flow shortage before the original market thesis has time to play out. Options have a different kind of discipline because the payoff structure is more clearly defined. For a long put, the break-even price equals the strike price minus the premium paid. If a put has a $50 strike and costs $3, the break-even is $47. The maximum possible loss for that put buyer is the premium, which is one reason many investors see long options as a more contained form of risk-taking. Most derivative mistakes are not caused by the contract itself, but by misunderstanding what the contract really exposes you to. With options, investors often ignore time decay and assume being right on direction is enough. With futures and margin-based products, many underestimate how quickly leverage can turn a small market move into a large account loss. Another common error is treating an OTC contract as if it had the same protections and liquidity as an exchange-traded one. Investors also forget to calculate break-even levels and focus only on whether they think the market will rise or fall. Derivatives can be useful and precise tools, but only when the contract terms, risks, and cash flow demands are fully understood. Section 2. Leverage. Leverage means controlling a larger investment position than your own cash would normally allow. Sometimes that comes from borrowing money directly, and sometimes it comes from a product structure that gives you amplified exposure. The attraction is obvious if the asset moves in your favor. The gain on your own equity can be much larger, but the same math works against you when the asset moves the wrong way. If $1,000 of your capital supports a $5,000 position, a 10% move in the asset is no longer a 10% move in your account. Leverage does not change the market itself. It changes how strongly your account reacts to the market. A simple way to measure leverage is to divide total position size by your own equity. If you hold a $1,000 position using only $1,000 of your own capital, you're using 10 to 1 leverage. That means a 1% move in the asset creates about a 10% move in your equity before costs. This is why even small price changes can feel dramatic in a leveraged account. The lower your equity base relative to the position, the more sensitive your account becomes. So leverage is really a multiplier of outcomes, not a source of return by itself. Margin matters because it determines how much of the position is really yours and how much is effectively financed by the broker. In a margin account, your equity equals the market value of the position minus the loan amount. If the asset price falls, the loan does not shrink with it, so your equity can decline very quickly. Brokers protect themselves by setting a maintenance margin, which is the minimum equity level you must keep. If your equity drops below that threshold, you may get a margin call. At that point, you usually must add cash, add securities, or reduce the position. This is why a trade can become a financing problem even when the investment idea still seems reasonable to you. A margin call is what happens when losses in a leveraged account reduce your equity below the broker's required minimum. You may be asked to deposit more cash, or you may have to sell part of the position to bring the account back into compliance. If you do not act quickly enough, the broker may liquidate positions without asking for your permission first. That forced selling often happens during stressful market conditions, when prices are already moving against you. In practice, this means leverage can take decision-making away from the investor at exactly the worst moment. So a margin call is not just an accounting event. It is a real loss of flexibility and control. Leverage appears in many forms, even though the mechanics differ from product to product. In a margin stock account, the investor borrows part of the purchase price from a broker. In futures, a relatively small margin deposit controls a much larger contract value. In Forex, leverage is often built directly into the trading structure, which is why small currency moves can have a big effect on account balances. Options can also behave like leveraged exposure, because a relatively small premium can produce large percentage changes in value. The common thread is simple. Small market moves can create much larger changes in your capital than you might expect from the headline price move alone. Leverage changes not only the size of outcomes, but also the speed at which damage can happen. With 2-to-1 leverage, a 10% drop in the asset becomes a 20% loss on your equity. With 5-to-1 leverage, a 20% adverse move can wipe out your entire equity stake. The higher the leverage, the less room you have for normal volatility, unexpected news, or poor timing. This is why risk management becomes essential rather than optional. Position sizing, exit rules, and an honest understanding of volatility are what make leverage survivable. A stock margin trade follows a fairly clear sequence. First, you open a margin account and agree to the broker's loan terms and maintenance requirements. Then you combine your own cash with borrowed funds to buy a larger stock position than cash alone would permit. After the trade is opened, you need to track equity continuously because equity equals position value minus the loan, and only the position value moves with the market. When you eventually sell, the broker is repaid first along with any interest owed, and whatever remains belongs to you. That means borrowing can amplify returns, but interest costs and falling prices both work against the final result. Suppose Anna invests $25,000 of her own money and borrows another $25,000 time to buy a $50,000 2-to-1 because her total position is twice her equity. If the stock rises 10%, the position grows to 55,000 times. After repaying the $25,000 loan, Anna is left with 30,000 in equity, which is a 20% gain on her original capital. If the stock falls 10% instead, the position drops to 45,000 and our equity falls to 20,000 dollars, a 20% loss. This example shows how leverage doubles the effect of the market move on her own money. As losses deepen, the loan stays fixed while the value of the asset falls, and that is what makes leveraged losses so punishing. If the position drops to 40,000 dollars while the loan remains 25,000 equity falls to 15,000 dollars, compared with an original equity investment of 25,000 that is a 40% loss. Yet the stock itself only fell 20%. This gap between asset performance and equity performance is the heart of leverage risk. The investor is not just exposed to market direction, but to the fact that debt does not adjust downward when prices decline. Before placing a leverage trade, it helps to know 3 core calculations. First, the leverage ratio tells you how large the position is relative to your equity. Second, equity itself is straightforward to compute, shares times price, minus the loan amount. Third, the margin call price helps you estimate the level at which the broker may require action based on the maintenance margin rule. In the example here, that margin call price is about $66.67. Even if you never memorize the formula, the exercise forces you to think about when a normal market decline could become a financing emergency. Most leverage problems begin with overconfidence about how much volatility an account can tolerate. Investors often ignore sharp swings and assume they will have time to react. but high leverage leaves very little room for error. Borrowing costs are another common blind spot because interest quietly reduces returns even when the trade works. Some people also use the maximum leverage available simply because it is offered, which is rarely the same thing as what is prudent. And waiting for the broker to manage risk is a mistake, because the broker's goal is protecting the loan, not protecting your long-term investing plan. Sensible use of leverage starts with choosing less than the maximum, not racing toward it. Section 3. Algorithmic trading. Algorithmic trading means using software to convert trading rules into automatic actions. Instead of watching the market and entering each trade by hand, the system receives market data, checks whether certain conditions are met, and then sends orders automatically. It can also manage the trade after entry by updating stops, tracking fills, or closing the position when exit rules are triggered. In that sense, an algorithm is really a decision process written in code. The value is not magic prediction, but consistency. If the rules are clear, the system can apply them the same way every time. Investors use algorithmic trading mainly for discipline, speed, and repeatability. A well-built system follows the rules exactly instead of hesitating, second-guessing, or reacting emotionally to short-term noise. It can also respond much faster than a human when markets move quickly or when many instruments must be monitored at once. That is why both institutions and some retail traders use automated approaches. The advantage is not that algorithms guarantee profits. The advantage is that they can execute a defined process more consistently than a person acting manually under pressure. Not all trading algorithms do the same job. A strategy algorithm decides what to trade and when based on signals, models, or rules. An execution algorithm starts after that decision and focuses on how to place the order efficiently in the market. For example, a portfolio manager might decide to buy 100 0-0 sessions, but an execution algorithm may split that order into many smaller pieces over time. The goal is to reduce market impact, avoid signaling too much information, and lower trading costs. So one algorithm chooses the trade idea, and another may handle the practical mechanics of getting the trade done. Execution algorithms are designed around different objectives. BWAP tries to trade in a way that roughly matches the market's volume pattern, aiming for an average execution close to the volume-weighted average price. TWAP is simpler and spreads the order evenly across time, regardless of market volume. Iceberg orders hide the full size of a large order by showing only a small visible portion to the market. Implementation shortfall methods try to balance urgency against trading cost, especially when delaying the order might be expensive. These methods all solve the same broad problem, but each makes a different trade-off between speed, secrecy, and price. A complete trading system needs more than just a signal. It begins with a market data feed that provides live prices, quotes, and sometimes order book information. A signal generator then checks whether the strategy's rules are satisfied. An order manager routes the trade, tracks confirmations, and monitors fills or rejections. Risk controls sit alongside this process to enforce position limits, loss limits, and emergency stops. And before any of it should go live, a backtesting engine helps evaluate how the strategy would have behaved historically. Good trading ideas can fail quickly if the system around them is weak. In practice, algorithmic trading is a workflow rather than a single event. The system first evaluates current market conditions against the strategy rules. If a signal appears, it builds an order and sends it to the market. After that, the work is not over because the system still has to monitor partial fills, cancellations, and possible repricing. It also updates positions, cash balances, and profit and loss in real time. Throughout the process, safety checks continue running in the background so the strategy stays within its risk limits. The signal may start the trade, but monitoring and control keep the process functioning. A trading system can have good rules and still perform badly if latency or data quality is poor. Latency is simply delay, and it can occur when receiving market data, making the decision, routing the order, or getting confirmation back from the exchange. Even small delays can mean entering at a worse price or missing a trade entirely. That is why some firms place servers physically close to exchanges, a practice called collocation. Data quality is just as important because stale, missing, or corrupted data can create false signals. In automated trading, Bad inputs do not stay small for long. They can become bad trades almost instantly. Consider a simple momentum rule. Buy one E-mini S&P 500 contract if the 5-minute price change rises above 0.3%. Suppose the system buys at 4,520 and then uses a sell rule that exits if price falls 0.2% below entry. If the contract later drops to 458, the system exits with a 12-point loss. At $50 per point, that loss equals $600 per contract. The important lesson is that the algorithm did exactly what it was designed to do. Automation creates discipline, but it does not remove market risk or guarantee a favorable outcome. A simple TWAP rule is a good way to understand execution logic. If you want to buy 10 W0 Series shares over 5 hours using 30-minute intervals, you have 10 periods, so the base target is 1900 Series per interval. Instead of sending a single large order, the algorithm places limit orders in each interval to spread execution over time. If only 800 shares are filled in the first interval, the unfilled 200 shares are carried into the next interval. That means the next target becomes 200 shares rather than 1 W00. This kind of rule turns a broad instruction into a repeatable process the system can manage automatically. Automation introduces a different set of risks, and they are easy to underestimate when a backtest looks strong. Overfitting is one of the biggest dangers, because a strategy can appear excellent on historical data while being too tailored to past noise. Transaction costs, spreads, and slippage can also erase what seemed like a profitable edge. Operational safeguards matter too, especially a kill switch that can stop trading if losses or abnormal behavior suddenly escalate. Latency monitoring helps reduce missed trades and poor fills, while data validation helps block false signals before they reach the market. A clever idea is not enough. Algorithmic trading needs strong controls around the idea. Section 4. Quant strategies. A quant strategy takes a market idea and turns it into rules that can be measured, tested, and repeated. Instead of relying on vague intuition, it uses data, formulas, and explicit instructions for when to buy, sell, or hold. That structure makes it easier to evaluate whether an idea actually has evidence behind it. It also allows the same decision process to be applied consistently over many trades or many assets. Quant strategies often look for recurring patterns in prices, returns, volatility, or other data. Their strength comes from making investing decisions more systematic and less dependent on mood or guesswork. The difference between systematic and discretionary trading is mainly about how decisions are made. Systematic trading follows explicit rules, so the same input should lead to the same action every time. Discretionary trading relies more on human judgment, interpretation, and context. That flexibility can be useful, but it also means two people may make different decisions from the same information. Rules make a process more repeatable, which is one reason quant approaches appeal to investors who want consistency. But repeatability is not the same as quality, because a flawed rule can produce flawed decisions over and over again. Quant strategies can draw from many kinds of information, not just price charts. They may use price and return data, but also volume, liquidity, and measures of volatility. Some strategies incorporate fundamental data such as earnings, balance sheet strength, or valuation ratios. Others look at market structure details, like order flow or cross-asset relationships among stocks, bonds, currencies, and commodities. The model itself can be simple, such as a rule based on a moving average, or more advanced, such as a scoring system or machine learning approach. What matters is not complexity for its own sake, but whether the model turns inputs into decisions in a way that can be tested and understood. Mean reversion strategies are built on the idea that prices sometimes move too far away from a normal or average level, then drift back. A common approach is to compare the current price with a moving average and look for unusually large short-term deviations. For example, if a stock drops far below its recent average after a sharp move, the strategy may treat that as an overreaction and buy. Some versions use standard deviations or other statistical measures to define what counts as extreme. These strategies often work better in choppy, range-bound markets where prices swing around a typical level. They tend to struggle in strong trends, because what looks cheap can keep getting cheaper. Momentum strategies start from almost the opposite assumption. Instead of expecting prices to snap back, They assume relative strength or weakness can continue for a while. A momentum system may rank assets by recent returns and buy the stronger performers while avoiding or selling the weaker ones. The logic is that trends often persist longer than people expect. This can work well in markets where leadership is clear and trends are sustained, but it can struggle when leadership changes abruptly or markets become noisy and directionless. So momentum is less about buying low and more about following strength while it lasts. Building a quant strategy usually begins with a hypothesis, a simple idea about how markets may behave. From there, the idea has to be translated into exact signal, entry, and exit rules that a computer or a disciplined investor could follow consistently. Those rules are then backtested on historical data to see how the strategy might have performed. After that, risk controls such as position limits, stop rules, or diversification constraints are added, and execution may be automated. Once the strategy is live, the work continues through monitoring and comparison of live results versus expectations. A quant strategy is not just an idea. It is a full process from concept to ongoing supervision. A strategy that looks good in a spreadsheet still has to survive the real world. Backtesting helps measure things like return, drawdown, Sharpe ratio, and turnover, which together say more than raw return alone. Out-of-sample testing is especially important because it checks whether the strategy still works on data it was not built around. Risk controls then define how much to trade, how much drawdown is acceptable, and when exposure should be reduced. Finally, execution matters because slippage delays and bad data can make live performance worse than the backtest suggested. In other words, a quant strategy has to be not only statistically promising, but operationally realistic. This SPY mean reversion example shows how a simple hypothesis becomes a tradable rule set. The strategy buys SPY when it closes more than 2% below its 20-day average, on the idea that a short-term overreaction may rebound. But it only enters if the VIX is below 25, which acts as a filter to avoid especially stressed market conditions. Position size is capped at 10% of a $100,000 account, so no single trade dominates the portfolio. The exit rule is straightforward. Close the trade when price returns to the 20-day average. A trailing stop 3% below entry is added to limit damage if the rebound does not happen. The example's results show that outcomes are shaped by more than the entry signal alone. Several trades rebounded after entry and exited as intended when price moved back toward the average. One trade did not recover and was stopped out, which limited the loss rather than allowing it to grow. The VIX filter also kept the strategy out of at least one setup during a riskier period, which is part of why filters exist. Over the sample period, the net return was 27%, and no individual loss exceeded the 3% stop level. That illustrates an important point. Filters, exits, and sizing rules often matter as much as the original market idea. Quant strategies can fail for reasons that are not obvious when you first look at a strong backtest. Overfitting is a major danger because the model may be learning the quirks of historical noise rather than a durable market pattern. Transaction costs and slippage can further reduce or eliminate an apparent edge. There are also data problems, such as survivorship bias or data snooping, that can make results look better than what was actually investable. Even a valid pattern can weaken if market regimes change and the environment becomes different from the past. And if execution is treated as an afterthought, a decent model can still produce poor real-world performance. The big takeaway is that quant strategies are powerful because they turn investing ideas into clear, testable decisions. That structure can reduce emotion, improve consistency, and make it easier to evaluate whether a strategy deserves capital. But the quality of the results still depends on the quality of the data, the logic of the model, and the realism of the testing. Backtests need to account for frictions, and live trading needs risk controls and careful execution. So quant investing is not about removing uncertainty. It is about approaching uncertainty with rules, evidence, and disciplined implementation. Section 5. Alternatives. Alternative investments are assets or strategies that sit outside the usual categories of stocks, bonds, and cash. Investors often consider them when they want sources of return that may behave differently from public markets. That different behavior can sometimes help diversify a portfolio, especially if the alternatives are not moving in lockstep with traditional assets. Alternatives also often come with different fund structures, liquidity terms, and access rules than ordinary mutual funds or ETFs. So the category is less about one specific asset class and more about investments that follow a different path from standard public market holdings. The potential benefit is diversification, but the structure is often more complex. The alternatives category is broad, but a few major groups show up often in portfolio discussions. Private equity invests in private companies, typically with a long time horizon and the hope of improving and later selling the business at a higher value. Hedge funds use flexible trading strategies, which may include short selling, derivatives, or leverage. Real assets include things like real estate, infrastructure, and commodities, which are tied to tangible assets or physical systems. Structured products are usually combinations of bonds and derivatives designed to produce a specific payoff pattern. These categories differ a lot, but they are often grouped together because they do not fit neatly into the standard stock and bond framework. One of the biggest trade-offs in alternatives is liquidity. Many of these investments ask you to give up the ability to sell quickly in exchange for potential return, access, or diversification benefits. Private equity can lock up capital for 7 to 10 years, which means you may not be able to get your money back when you want it. Hedge funds may only allow redemptions quarterly or annually, and even then, sometimes with restrictions. Real assets can also take time to value and sell, while structured products may be expensive to exit before maturity. Illiquidity is not automatically bad, but it only works if the investor truly can leave the money untouched. The risks in alternatives often go beyond normal market volatility, and that can make them harder to evaluate. Transparency may be limited, so investors do not always see positions, valuations, or leverage as clearly as they would in public funds. Some alternative investments rely heavily on manager skill, which adds another layer of uncertainty. Others include counterparty exposure, valuation subjectivity, fee complexity, or tax complications. A product can even appear stable on the surface while hiding leverage or hard-to-price assets underneath. That is why alternatives should never be judged only by a smooth return line or a marketing summary. Because alternatives often have uneven cash flows and less frequent pricing, investors use evaluation tools that differ from the usual public market metrics. IRR, or internal rate of return, reflects the timing of cash flows, which matters a lot in private investments. MOIC, or multiple on invested capital, simply compares total value received to the capital invested. Some investors also look at downside capture, which asks how the strategy behaved when broader markets were falling, and fees deserve close attention because they can materially reduce what investors actually keep. In alternatives, gross returns can look attractive while net returns tell a more modest story. Access to alternatives is often limited in ways many individual investors underestimate. High minimum investments are common, and some offerings are restricted to accredited investors who meet income or net worth standards. Even when retail-friendly versions exist, such as certain ETFs or feeder funds, that does not mean the strategy itself has become simple or low risk. Easier access can improve convenience, but it does not replace due diligence. Investors still need to understand fees, liquidity terms, strategy design, and the underlying risks. Accessibility and suitability are not the same thing. A practical way to evaluate an alternative investment is to begin with the portfolio role it is supposed to play. Is it meant to diversify equity risk, provide income, hedge inflation, or seek higher long-term return? Once that purpose is clear, the next step is to review structure, including lockups, redemption terms, leverage, liquidity, and valuation practices. After that, look closely at fees, concentration, and the manager's actual process rather than just the sales pitch. Finally, decide in advance how you will monitor the investment through reports, cash flows, valuation updates, and manager communication. Alternatives should be chosen through a process, not just through attraction to a story. Suppose Maria has a $15 million portfolio invested in stocks and bonds and wants to reduce her dependence on public markets alone. She shifts 15% or $225,000 into a private equity fund and 5% or $75,000 into an infrastructure ETF. That leaves her with an 80% traditional allocation and a 20% alternatives allocation. The private equity fund may offer a higher long-term return target but comes with illiquidity, while the infrastructure ETF is more liquid and may add income. If public stocks have a weak period, the overall portfolio may still decline, but not as much as before, if the alternatives behave differently. This is what diversification aims to do, not eliminate loss, but reduce reliance on one set of market drivers. The most common mistakes with alternatives usually come from unrealistic expectations. Investors may ignore liquidity needs and commit money they might actually need sooner than expected. Others chase headline returns without asking how much risk, illiquidity, or fee drag was required to produce them. Some assume diversification is guaranteed, even though correlations can rise during periods of market stress. Complexity is another trap, because a more complicated product is not automatically a better one. Alternatives should earn their place in a portfolio by solving a clear problem, not by sounding sophisticated. A useful practice exercise is to test what a small alternative allocation would mean in an actual portfolio. If you start with a $500,000 portfolio, a 10% allocation means moving $50,000 into one alternative and leaving $450,000 of the portfolio. You might compare a REIT, a managed futures fund, and a private credit fund. Then ask how each one relates to stocks and bonds. You would also want to review liquidity terms, fees, and any special risks before deciding which source of funding to reduce. Just as important, think about how you would monitor the position after buying it. The purpose of the exercise is not to find the most exciting option, but to make the decision process concrete and disciplined.